Hello, everyone. Welcome to a Wall Street for Main Street podcast special. Today, special guest. We have two special guests on today. Our first guest is David Morgan, who's the editor of the Morgan Report and the author of Get the Skinny on Silver Investing. David, thank you for joining us and welcome back.
My pleasure. Thank you, Mo.
Our next guest is Chris Marchese. He's a mining analyst for the Morgan Report, and he will soon have another newsletter coming out, which we'll discuss later. Chris, thank you for joining us again.
Great to be here. Thanks.
All right, David. Well, first topic I want to talk about is now that the election is over, and me and Jason and John have predicted that the gold and silver prices would consolidate up until the election when they had a big run-up in the late summer. Now that the election is over, where do you see the gold and silver price going from now to the end of the year?
Well, I think that we're going to see silver settle at the end of the year somewhere between 35 and 40. And for gold, I think somewhere around the $1,800 level.
Okay. And Chris, now that the election is over, where do you think the price of gold and silver will go?
I'm guessing it's hard to disagree with David, but, probably the high 30s and 18 and change for gold.
Okay. Now, I've noticed that when gold and silver had that big run-up in the late summer, there's a lot of the commercial banks had been piled up on their short position. Do you think that has anything to do with the election, or people just want to, or people are betting that the price of gold and silver will dip?
Well, I would say that it may have had something to do with the election. I doubt that. It's normal market activity from the aspect that these short players basically go with the flow. In other words, as there's a lot of interest in the metals and there's buying pressure in the futures market, for every buyer there has to be a seller. So if there's a lot of volume increasing on the buy side, someone has to take that other side, which is sell, which is primarily, but not only, bullion banks and large banks that represent bullion banks primarily. So I think it was just basically the market pressure for people buying through that summer rally, and then it sort of topped off, and I think everyone was hesitant to buy much during the election. It was basically overbought, particularly based on the commitment of traders reports. It was fairly clear that the market was at a juncture where it was probably due for a sell-off. I was perhaps a little too bullish, but the last update I did, primarily looking at the commitment of traders, said I was concerned, but not as much as I normally am, because the market was showing such good strength at that time. But I expected it to sell off, and lo and behold, it did, and probably sold off a bit more than I expected. I thought we'd get a sell-off to about the 32.50 level or so, perhaps 31. And obviously, as we speak, it's down to, it's been down to 31. It looks like that's about as bad as it's going to get, but we don't know for sure.
Yeah, and I'm looking at the silver chart right now, and it looked like that the silver bounced off the 200-day moving average and went back right up. So the 200 moving average is pretty much the support now for silver. And I did not think it would go below 30, and I believe you would agree with me there as well. And it presented a great buying opportunity for people who wanted to buy at these levels. And Chris, looking at the commitment of traders report, what do you think will happen from here to the end of the year? Do you think the commercials will start covering their short position, or do you think they'll keep piling on now that the election is over?
I do think there'll be a bit of short covering, which in part will drive prices higher to David's target between 35 and 40. They've added a lot of net short positions historically from the summer months relative to late October. And it's bullish from my point of view that silver held in so strong with the net short position increasing so drastically.
And that's a great point. And we should expect to see silver and gold in conclusion to go up a little bit more to the end of the year. And then do you guys think that 2013 will be a better year for the precious metals market than 2012 and 2011, where it was pretty much had little gains and a lot of consolidation? David?
Yeah, I primarily do. This sounds like I'm making it up, but I'm staying in my integrity. When we had the run in 2011, we went from the breakout at 19 up to 26, and from 26 all the way to 48 basis, the QE2 announcement. When I saw that parabolic move, I tried to be very cautious in my private work for our paid members and also in the public domain for people to listen to shows like yours, Mo. And I said and wrote in the report that those kind of moves usually take a year and a half to 2 years to consolidate. So a year would be, April 2012, and 2 years would be obviously April 2013. I think the consolidation's over, but we can't be sure until we break out above 35, and we hold that for some amount of time on good volume, and then we see some carry through. But I'm pretty strong that we'll break through by the end of this year. So now to answer your question, I think 2013 we're going to see new highs nominally on the nominal price in silver. So I'm looking for 2013 to be a good year for silver and over the entire year, not meaning it's going to go up and up, but I'm looking for 60 to 75 in 2013. On silver, and I think gold will be into new nominal highs and probably in the $2,200 to $2,500 range. And those may end up being conservative depending on what goes on with the Eurozone and, of course, even here with this fiscal cliff that everyone's talking about.
That's a great point. And Chris, what do you think?
Well, it's hard to disagree with David. The metals look like they're poised to just take off. I think silver is going to, take its next leg up, into phase 2, past $50 an ounce, and silver past $2,000 an ounce. One driver, I think, is not only the lunar buying, is also, I think, the Fed will announce, in addition, 40 to 45 billion of bond buying in January or February, just because it goes along with their strategy of keeping interest rates low all throughout the yield curve. And there would be no point in buying all those mortgage-backed securities if the interest rates started to rise. So I think that because Operation Twist has to come to an end because they're running out of maturing securities, that they'll have to announce a new round of buying. And that would spark, I think, a pretty big rally because that would bring the total to, say, 80, 85, 90 billion a month. And if you count it from when they announced the initial QE3, that would be 1.1 trillion just assuming they continued this until the end of 2013.
And that's an interesting point. I've heard rumor that the Fed will announce a special QE from the hurricane disaster in New York City because it's estimated that they need $33 billion to rebuild New York City. So that'll be very interesting. Now, I want to shift gears to the mining industry and discuss the current state of the junior mining stocks financially. We interviewed Nolan Watson, the CEO of Sandstorm Gold and Metals and Energy, a few months ago, and he said that most junior miners are struggling financially, and any miner that with the market cap of 10 million or less are most likely to go bankrupt or be sold for pennies on the dollars. So I want to ask you guys, since you guys look at mining stocks almost every day, it looked like, has the condition improved for the junior mining financially, or has it gotten worse for them? David?
Oh, well, Mo, I almost asked you to ask Chris first, but it doesn't matter. We kind of agree on this one, I think. First, you have to look on an individual case-by-case basis. I mean, there are certainly companies out there that are pretty well cashed up, and aren't in any jeopardy. And then you have other ones, as Nolan indicated, that might have very good assets, but they're cash poor and perhaps can't really raise money. And if that's the case, then they're really takeover targets. So generally, I'll say this. Generally, yeah, they're under cashed, and the environment to get new capital into these companies is pretty difficult still. So depending, again, on a case-by-case basis, you have to evaluate them. But the junior mining sector has not really moved well versus what's gone on in the mid-tier category and the upper-tier category on this recent move in the metals. Some of the juniors that actually have merit. Now, I want to be clear that what we have in the Morgan report, for the most part, have done quite well. There's a couple of the laggards in there, but overall, our picks are doing quite well. But if you get your average stock picker that does it on their own or reads somebody else's work, I'm sorry for the ego, but a fact is a fact. They're not keeping up.
And now, Chris, many of the junior miners struggled to get funding to get their mines in operation. Now, you look at the gold and silver market, it's been in a bull market in the past couple of years, making new highs almost every year, and yet these junior miners are still having trouble getting funding. Why is that? It is because the Wall Street and the hedge funds and the money managers still have this doubt about the bull market and are afraid to invest in the junior mining, or does that have to do with the risk of putting a mine in operation?
Well, I think it has to do with what's happened after 2008. It's opened everyone's eyes to make more prudent investments. And the mining sector in general is inherently risky. So it's become more difficult to make these so-called more prudent loans. And, if I was a bank, I'd do the same. I would only make loans to either companies that were already in operation and needed more to bring on another asset or mine, were almost at production and just needed a little boost, capital injection, or 3, a company that was a few years away but had great assets. Ones that had average to less than mediocre assets, I wouldn't touch if I were a bank. And I think that's how they're approaching it.
And that's a great point. And another aspect of the mining industry that we have to look at is the production costs when they're in operation. And with oil prices so high, we're finding a lot of the mining stocks having trouble keeping their production costs in control. Now, Chris, I wanted to ask you, do you believe production costs is a big factor when you look at when you analyze all these mining stocks and whether you want to invest them or not?
Yes, production costs are an extremely big factor. That's why David would probably agree with this. We really like high-grade operations because costs tend to be lower. I'm not a fan of low-grade bulk tonnage operations that have, half a gram, up to even 1 gram per ton gold, just because they're more susceptible to being impacted by rising input costs. And oil makes up roughly 20 to 30% of those.
And yeah, great point. And also, when you consider that, oil prices are going up, but, gold and silver prices are going up as well, that would offset the rise in production costs because they're getting a rise in revenue. What do you think, Chris?
Yeah, and in a lot of cases, input costs are outstripping the rise in gold and silver prices.
Okay, can you give us an example of a company that had the input cost go down because of the revenue or the gold sales have gone up?
Well, we could take, for example, Brigus Gold. They were initially this is about 2 years ago, forecasting $475 to $500 an ounce cash costs, and now, they're forecasting a little over $600 now. So it's being priced in, and while they're making cash flow, it's not nearly to the degree that they would have if input costs had remained the same.
And great point. Great. I want to shift gears to asset allocation strategies when it comes to investing in the precious metals market. Now, a lot of investors ask what's the best way to diversify your portfolio if you want to invest in the precious metals. We have the royalty, the streaming company, the mining stock, you have ETFs, you have mutual funds, and to me, investors that don't have that much knowledge in the mining industry or don't have high risk tolerance, they're better off investing in the royalty companies or the ETFs rather than putting their money at risk in mining stocks where a mine could go wrong or production there's a setback in production, and that could hurt the stock price. So, David, I wanted to ask you, what for investors out there today that want to get in the precious metal market, what is the best way for them to do it?
Well, we've got to be consistent here, Mo. First of all, I've always told everyone, if you want to get in the precious metals market, you need to buy the precious metals first. So once you've established a position in physical gold and silver, usually in coin form, then you're ready to move on to the mining sector. And the reason you want to do that or could consider it is that you get pretty good leverage, although at times, due to the advent of the ETFs, the leverage in the mining companies hasn't been as robust as it had in past bull markets, but I expect that to change here in a not too distant future. Regardless, it's an individual choice, and it's also a sophisticated situation. A lot of people that invest generally don't really have that much experience, so they have a lot of choices in mutual funds if you're a general stock market investor, so you can put your money with the money manager, and if you do your homework, you can actually choose a few that will actually help you make money. Most of them really do not perform as well as the averages themselves. I'm off track a little bit. Let me come back. I think that it's an individual choice, but really to do well in this sector, you've got to get some pretty good advice or really do your homework. The problem is in this sector, there's too many newsletter writers or analysts, if you want to call them that specialize in the very much undervalued microcap sector. And that's not where I want to put much money. Personally, what we do at the Morgan Report is how I learned to invest, and that's because I made some mistakes when I was much, much younger. And I put, substantial funds in top-tier, cash-rich, unhedged mining companies with good management, proven track record, can lower their margins, and a lot of those happen to be royalty companies. But I'm here to make money. I'm not here to pass judgment on what company might make a big discovery or this or that. I'm here to analyze what's going to produce the most revenue and how I'm going to make the most money by investing in this sector. After that, I like the mid-tier companies because they have a better growth profile, and a lot of them still have some exploration potential, and they can lower their margins sometimes because they can increase their production rate, and sometimes they can also reduce their capital costs, not so much for labor or the fixed costs, but sometimes they can lower it in other ways by implementing, a larger mill as an example, where the payback on that type of thing is much better, or putting in a different circuit that might take out a nasty in the flotation circuit, or put a circuit in that would actually produce a byproduct metal at a more lucrative yield. So that's the second one. And then lastly, speculation. I mean, I can't get away from it, but this is where you want to bet a little and win a lot. You don't want to put a lot of money in. A lot of people make that mistake. I did myself when I was a young investor because I was kind of bitten by the honest money thing after I discovered how the fractional reserve banking system worked. And, the worst thing that can happen to somebody is what most people think is the best thing, and that's picking some ABC junior mining company and paying 10 cents for it and having it go to $1 within about 3 to 5 months after you buy it. And if that happens to you, look out, because you think it's easy. You think it can be done again and again and again. And believe me, it's not as easy as it appears. So we do speculate. That's where Chris has been really superb for us, because we like value. And when we can find value, I don't care if it's a micro cap, a micro cap, a mid tier, a top tier, or whatever. If we find value, we're going to find it and report on it. So I probably was a little long-winded on that, Mo, but as you know, it's part of my passion on money, metals, and mining. I want to get the money part straight so people know why to be in the sector. I want to get the metals part straight so people know why gold and silver are the top tier of all the commodities and always have been. And lastly, on the mining side, we're no nonsense. We're not here to look for moose pasture. We're not here to tell you some story. We're here to help you make some money.
And that's a great point. Now, Chris, I've known you for a while, and you've been a bit of an advocate of having a heavier weight on the royalty and streaming company rather than a mining stock for people that don't know that much about the mining industry. Could you elaborate on that for our audience, please?
Yes, and even people that don't know much, even people that do know a lot, I would advocate having a pretty substantial portion in the royalty companies, just because they provide a great return year over year over year. So if you get a company that returns, say, 20, 25% compounded out for 8 years, you've done pretty well for yourself, considering most money managers are happy with an 8 to 10% return per year. And I think when the time comes, the royalty companies will be the leaders in dividend payouts. Right now, they're in their growth phase, and they haven't matured yet. So there's a lot of room for them to increase their dividends. Many of them have favorable tax policies, especially with their streaming, the streaming part of their portfolio. So the risk reward is just so attractive. It's hard to not advocate everyone having a certain proportion of those in their portfolio. It's hard to say what someone should have or shouldn't have, because everyone has a different risk reward profile. Some people like to search for those 10 and 20 baggers in the junior exploration, but those are rare. And frankly, we don't mess around in those. We try to find actual value. Companies that are cash flowing or soon to be cash flowing, because we see value in those, and that's just the base case scenario. There's obviously room for lots of upside, like David was mentioning.
And that's a great point, and I agree with you. I think people that don't know much about the mining industry should have a heavier weight in royalty and streaming companies, because you don't have to worry about the risk that the mining, gold and silver mining companies take on, like the operation risk, management risk, geographical risk. So
it's like Pierre Lassonde says, the chairman of Franco-Nevada. They're ETFs on steroids, and they really are.
And yeah, I agree. That's a great point. That's a great way to put it. Now, if you look at the leverage-wise, compared to leverage for the royalty companies and compare them to the mining companies, are they less leveraged compared to the mining stock, or are they more leveraged?
I've seen them outperform almost everyone I know that picks and chooses in the actual operators. So I would say they're just as leveraged, if not more.
So there you go for our audience. So you get the growth, and eventually you get the dividends. So you can't get any better than that with the royalty company. Now, a lot of people ask when they look for mining stocks, how do you find an undervalued mining stock? How do you find a stock out there that's undervalued and would be a good investment? Now, Chris, you're good at finding those. What are the things that you look for when you're finding an undervalued mining stock?
Well, first you gotta get the basics: management, high quality assets, and then you gotta look at cash flows or potential cash flows when in operation. And that's kind of more of an art than a science, so I can't really expand more on that.
Oh yeah, I completely understand. Now I want to shift gears. Then you guys were at the Silver Summit a couple of weeks ago. Now, David, I want to ask you: is there anything that you learned from the summit regarding the gold and silver market that you didn't know before?
Well, I certainly don't want to appear like I know it all, because believe me, I try to learn something new every day, and there's plenty about the silver market I learn or have insights in or whatever. As far as from the conference, yeah, I think one thing I learned about that, now that it pops in my head, is I'm kind of stalling to think, is that there were some junior companies there that quite frankly, I wasn't all that interested in personally. I hadn't done a lot of research on it, so kind of at a cursory level, that one of the majors is quite interested in. So I'm going to take a leap of faith here. This is opinion only, not fact, but my guess is that some of these larger silver companies are in a situation where for them to grow, they got to kind of go out and, either find assets or acquire assets that someone else has found. So that was a bit of a surprise because, earlier in your show, Mo, you asked about, what's going to happen to some of these junior companies and what are the finances like. So, not to talk out of both sides of my mouth, but, these are situations, as we did discuss, and I'm being consistent here, where you can have some asset that, is valuable, and the company isn't is cash poor. It doesn't really have the money to develop it any further. And someone that does have cash in the treasury can come by and purchase it and build their company bigger because they're buying an asset at a good value or a good price.
Now, I saw a video with you, David, and Chris talking about currencies, and I want to ask you guys about the gold standards and the advantages and disadvantages. Now, Chris recently made a statement that we should have a bimetallic monetary standard, meaning a gold or silver standard or some other type of precious metal backed in to the monetary standard. And as you know, right now, the fiat currency is backed by nothing. When they print out of thin air. They can print as much as they want. The government can borrow as much as they want. And we're now in a situation we are now where $16 trillion and going higher. So, Chris, I want to ask you, what are the advantages of having a bimetallic monetary standard compared just to the gold standard?
Well, for one, it keeps tighter checks and balances on the government inflating. For example, if it was gold and silver and they started debasing just the monetary system in general, or clipping coins or, whatever it may be, the undervalued coin metal per Gresham's law would flow out of the country. So so that would give an indication that the government was inflating, and that's the biggest reason why I think we should have a bimetallic standard. And it's competing currencies are always better to have because it's the market's money, it's the people's money, it's what they choose.
And that's a great point. And you mentioned a competing currency. Now, David, explain to your audience, how would a competing currency work in an economy? Because people like Ron Paul have been a bit advocate of competing currency as well.
Well, how it would work is it would be very slow at the beginning. I mean, there would be very few people that would even understand what was taking place. But depending on what happens in the general economy, So if you have a hyperinflation or a high rate of inflation and people start to catch on to what really goes on, they would seek some means of protecting themselves. And that would accelerate what I'd call the wake-up call for people that would gravitate quickly to the alternative currency that maintains purchasing power. Right now, even though gold and silver have not only maintained purchasing power, but actually increased your ability to maintain, improve your purchasing power over the last decade, there's still so few. And one of the reasons is the mainstream. The mainstream is predisposed to talk about the stock market, the Dow Jones Industrial Average, or something along those lines. They are not advocating gold and silver purchases on Wall Street. And yet, that's probably been, or not probably, that has been one of the best places to put your money over the last decade. But again, you're not going to hear that from them. But people finally wake up. So again, if you have a situation where the dollar or the peso or whatever currency you're in starts to devalue at a rate that it really starts to concern the populace, they'll find a way out pretty quickly if there is an alternative currency. The problem with the alternative currency as it is right now is that it's pretty cumbersome to take a gold coin or a silver coin into any merchant and be able to trade with it over the counter and buy a good or service, buy a dress, buy gasoline or whatever. The counterparty, the merchant, doesn't really know what to do with it. And the only way really that I see around that is to have a debit-based system where you could back your debit card with precious metals of your choice or combination of precious metals, and then you go in and it's transparent to the merchant. All he's doing is using those electronic apparatus, his system that's already in place. And then, of course, on the other side, you as holding the card would be debited a certain amount of metal. I think that would work quite well if it was available. And actually, there is a startup here in Spokane that has that system in place, and it's basically in its infancy, but it seems to be working quite well right now.
I'd like to add one more thing with when Ron Paul talks about competing currencies, he's saying let the dollar circulate, but add gold and silver along with it. And then because he knows that no one would trust and use a piece of paper backed by nothing. That's his way of, just showing how the market, it wouldn't be the market's money or the people's money.
And that's a great point. And the people out there are already saying that silver is the people's money because it's more affordable compared to gold. And so people can easily purchase that. Do you agree with that, Chris?
I don't really think it matters the price of any of the metals or, some people say, oh, there's not enough gold in the world for there to be a gold standard. Because when it really got implemented, the banks would have all the currency backed by these metals, and exchange would still take place with dollar bills and coins and such.
And that's a great point. And so the final topic I'd like to discuss before I let you guys go is the election. Now that the election is over, thank God, we don't have to watch any more of those ads, commercial ads on TV during a football game. So the election is over, and it's what I expected. I thought Obama would win, and he did win. Not much changed in Congress. The Republicans still hold the House. The Democrats still hold the Senate. And for the next 4 years, how do you think this election will shape the economy? Do you believe this next 4 years will be a lot different than what we've seen in the past 4 years, which is, we had stagflation, where we had inflation and high unemployment? We'll see something else in the next 4 years, maybe hyperinflation. What do you think, David?
Well, I think that, as you said, Mo, the status quo, it's pretty much, no real change, not only at the level of the presidency, but also both the Senate and the Congress. However, I don't think we can go another 4 years. So I think there'll be a lot of rhetoric from politicians saying, oh, fiscal cliff, we should this, we should that. There'll probably be some policy implementations. But I think if you really want to get a good idea of what's going to go on in the future is to go watch the movie Atlas Shrugged 2 and find out that, the Depression becomes apparent to almost everyone. And the unemployment continues to get higher and higher and higher. Economic conditions continue to decline because of the policies that are going on trying to make it better, and they continue to make it worse. If these policy fanatics would get out of the way and let people that really know how to do things, we could probably get this thing turned around in a rather quick and efficient method. But that's not what's going to take place in my very studied view. This history is repeating. So you'll have a lot of people that will promise a lot of things to make it better, but their actual actions and policy implementations will make it worse. I don't see it real bright. I don't hate to be a doom and gloomer, but the hope is that there's some kind of an event or events that take place that basically reduces government, where they cannot pay all of these government workers, where basically it cleans house, so to speak. I mean that, as a metaphor, but it cleans out the Congress maybe and the Senate and sweeps things clean as a metaphor, where you can start to really do things without a lot of obstruction. And if that were to be the case, then again, I think that the spirit of the people, the entrepreneurial personality of Americans in general, and their ability to live, with not only within their means, but within the conditions that they find themselves in, would triumph the day. But I don't see that happening for some time.
And that's a great point. You make a good analogy to Atlas Shrugged 2, the movie that came out months ago. And Chris, I want to ask you, do you think there will be a event in the next 4 years that will happen that didn't happen in the last 4 years under Obama?
Yeah, there'll be, I'm a bit more pessimistic than David, but I think there'll be headline inflation, even though it's doctored to death, which is, has, very dire consequences. And, I don't think our deficit's going to get under control anytime soon, which is going to cause a larger proportion of that to be funded by quantitative easing or the like. So, we're stuck between a rock and a hard place at this point, in my view at least. Maybe if we had got someone like Ron Paul or something to win this time around, even though that was only a pipe dream, maybe they could do a lot of the damage that has been done. The system is more levered than it has been. People claim we're going through deleveraging. I don't know what they're looking at. So just the damage Obama did in his first term would take, I think, years to repeal, and not to mention, all of that done by President Bush before that. So with him, another 4 years, I think we're going to have some kind of significant currency reform, or if we're able to last into the next presidency without anything big happening, they're in for a world of trouble, because at that point, I think the system will be beyond saving.
And that's a great point. And Ron Paul, who did an interview today on Bloomberg regarding the fiscal cliff and the debt problem that we have, which is projected to hit $20 trillion at the end of Obama's second term, at least $20 trillion. And he had a quote regarding the problem with government and spending and the debt, and I want to read it here. And he quoted it: "People do not want anything cut. They want all the bailout to come. They want the Fed to keep printing the money, and they don't want to believe that we've gone off the cliff or close to going off the cliff. They think we can patch it over, that we can somehow come up with some magic solution. But you can't have a budgetary solution if you don't change what the role of government should be. As long as you think we should be the police of the world and run this welfare state, all we're going to argue about is who is going to get the loot. Now, David, do you think the debt problem and the spending problem is something that we cannot fix?
Yeah, I do, because human nature. I mean, if you study monetary history, what you find is human nature doesn't change. And the name, shame, and blame game will go on until Rome burns, as a metaphor, but it happened in the Roman times, as we all know. So there'll be the Senate arguing with the Congress and the President arguing with the House and the Senate and all this political entertainment as the country, as a metaphor, burns. And so markets have a way of clearing themselves eventually. And again, I think it will take place within the next 4 years. How and exactly, when it will, I don't know, but I know the why. The why is because no one will actually stand up and tell the American people or the globe, really, because this isn't just an American phenomenon. This is going on in Europe. This is going on basically all over the globe with a debt-based monetary system, and no one can write. And the only way to get back to integrity is get back to honesty in the financial sector. And that's not going to happen until after the collapse, in my view.
And that's a great point, and I agree. I think people are still too dependent on government for them to do everything. And I think the American people, even though the people are starting to wake up, and the younger generation, it's not enough right now to make a change in the government and how they do business. Now, David and Chris, I'd like to thank you guys for coming on the Wall Street from Main Street podcast. David, if people want to find out more about what you do, where can they go?
All they need to do is go to themorganreport.com. It's all one word, themorganreport.com. That's the main website. If you're interested in following a couple of our channels, for those that like Twitter, it's SilverGuru22. That's SilverGuru22 on Twitter. And for the YouTube fans, and that seems to be the most popular, just type in Silver Guru into YouTube and we'll get the channel. And we put up almost all the feeds we get, like yours, Mo, on the YouTube channel. So basically it's kind of a one-stop shopping if you want to listen to a recording or watch a video.
And that's great. And I think your newsletter is one of the best out there when it comes to talking about the economy, gold and silver market. So we appreciate everything you do. And Chris is also the contributor to the Morgan Report. Now, Chris, you also have a new report coming out. You want to tell our audience more about that?
Well, it's actually a new website. It's kind of I don't know if you'd say sister site, but it's affiliated with the Morgan Report. And basically it's more focused on investments, whether it be equities, debt securities, warrants, options, etc., as well as a newsletter focusing on those types of things, and that will be weekly. We expect the launch to be within a week, give or take. So yeah, that's pretty exciting, and that's about it.
Now you're going to be covering the gold, silver, oil market, a big range of commodity markets. Is that correct?
Yeah, yes, just natural resources in general, and we'll have audience participation. So if they want a specific company covered, they can just submit it to us, and we'll take a look at it and possibly do it.
Okay, that's great. Well, I wish you all the luck with your new report, and obviously the Morgan Report is already a success, and you guys do great work and provide great analysis and insight on the mining industry and the gold and silver market. And I think, as I said before, it's one of the best newsletters out there. And I appreciate you guys coming on for a podcast, and hopefully we can have you on again.
Thank
you
you
very much.